Wall Street and the nation's economy is in a state of crisis. The nation's fifth largest investment bank, Bear Stearns, nearly collapsed last week. It was saved only after the Federal Reserve took extraordinary measures to help JPMorgan purchase the 85-year-old firm. As part of the deal, the Fed put up $30 billion to guarantee Bear Stearns' riskiest investments. For the first time ever, the Federal Reserve has become the lender of last resort for other investment banks in an effort to prevent firms from going under. It is a move that marks one of the broadest expansions of the Fed's lending authority since the 1930s. At least 10 investment funds, including the fund Carlyle Capital, run by the Carlyle Group, have recently collapsed or been forced to sell assets. Consumers are feeling the effects of the economic crisis everywhere. Food prices are rising, gas prices have reached all-time highs, the dollar is weakening, credit card debt is expanding, home prices are falling, and foreclosures continue to rise.
A year ago, Treasury Secretary Henry Paulson predicted the fallout from the subprime mortgage crisis was, quote, largely contained. But now Alan Greenspan is admitting the current economic crisis will likely be the most wrenching since the end of the Second World War. And then there's the occupation of Iraq, which has just entered its sixth year. The Nobel Prize-winning economist Joseph Stiglitz projects the war will cost at least $3 trillion. We're joined right now by two guests. Nomi Prinz is with us. She's a former investment banker turned journalist. She used to run the European Analytics Group at Bear Stearns. She's the author of two books, Other People's Money, The Corporate Mugging of America, and Jacked, How Conservatives Are Picking Your Pocket. She's now a senior fellow at the think tank Demos. Max Fraad Wolff is an economist and writer. He's an instructor at the Graduate Program in International Affairs, New School University here in New York. He's a frequent contributor to the Huffington Post, Asia Times, and The Independent. We welcome you both to Democracy Now! Nomi Prinz, this story is personal for you. You worked at Bear Stearns.
Yes, actually, I did. I worked there from 1993 to 2000. So I actually worked there through the emerging market crisis and the Asian crisis and long-term capital management's implosion. And the start of CDOs, the collateralized debt obligations that are sort of at the crux of a lot of the hedge fund and credit hedge fund implosions that I believe have had more of an impact on the negative aspects of the economy than the actual level of housing prices. It is the fact that investment banks could leverage and lend and leverage and lend and so on to create so much leverage in the market that the market cannot contain it. Hence, the Fed coming in and actually becoming an investment bank of sorts.
Yeah, this issue of the CDOs, as you mentioned, these collateralized debt obligations that really were the underpinning of this increased subprime lending that went on. Clearly, we've discussed in previous shows that everyone was able to pass the blame onto someone else along the chain, from the original broker or the mortgage lender down the street to the firms in Wall Street. But to what degree is it your sense that those that were packaging these loans knew very well the risky nature of the lending practices that were at the bottom of the scale here at the street level?
It's not even a question they knew. They actually are predicated on lending practices being risky, because a risky lending practice means that interest rates on a particular lending practice are higher. That means when you package them into CDOs and other types of securities, they look like they have more of a return for investors or hedge funds that then buy them along the way. So there's a desire for risk in the market.
What should we understand about Bear Stearns and this bailout?
Two things. One is that this bailout, which is not merely a bailout, it is the Fed acting as an investment bank or as a hedge fund. They are taking $30 billion of risky assets. That's not merely overstepping, which it also is, the lines between a government body and the public and the banking system. That is taking on additional risk that, instead of admitting, should not have been there, should have been regulated away. We should have had not just lending practices, but leverage practices on Wall Street regulated and transparent and curtailed. It is a way of not having to admit anything and throwing money into a declining economy and an increasing problem in order to look like everything is okay. The statement by Paulson, who used to run Goldman Sachs, that was a large player in the CDO market after Bear Stearns started it. he is also not taking any blame for the system's collapse because of its own choice to create these risky assets, to leverage them, to not talk about them, to not describe what is in them, and to not show it to the SEC, to the public, to anyone.
I'd like to ask Max Wolff, this issue of the government oversight and regulation. People forget now that it was back in the Clinton, in the latter part of the Clinton years, that Glass-Steagall was eliminated. And I think Rubin's last act as and also a former Goldman Sachs person, right? His last act before he left the Clinton administration was achieving the end of the Glass-Steagall Act. To what degree did that have an effect on how these kinds of risky investment practices are jumping over into the regular banking system?
Yeah, it's a great question. I mean, there's also debate about whether that was his last act at the Department of Treasury or his first act at Citigroup, because it was Citigroup's merger that would have been illegal had Glass-Steagall not been repealed.
Explain Glass-Steagall.
Glass-Steagall was a law put in place after the Great Depression that created what they call a firewall, or a separation between investment banking and commercial retail banking. The idea being that you want to contain the potential breakout of problems in the financial system so that it can't spread like wildfire and roughshod across different segments of the industry, more or less like it has across different segments of the U.S. financial industry in the last, say, 10 to 12 months, with absolutely devastating results, which is still ongoing, so we can't sum up the damage done because each day there's more damage. A little bit like the war in Iraq. Getting a tally on the damage or cost of Iraq is impossible because it goes up while you're trying to measure how much it went up the day before, the week before, the month before, the year before. So it's a bit of a mess. So Glass-Steagall is part of an old regulatory framework that has been systematically torn down. The tearing down of that framework has allowed global financial markets to integrate, which has allowed vast savings to pour into the United States, new financial products to be innovated by Wall Street and all kinds of different financial firms without regulation outside the core of the banking system, which built up and built up and built up and was celebrated and celebrated and celebrated as the efficiency and the genius of the free market until, of course, with no brakes and no skid marks at the scene of the accident, it hit a brick wall. The only thing I might add to that is I take a bit of an issue with the description that Bear Stearns was bailed out. Everybody Bear Stearns does business with was bailed out. Bear Stearns was taken out by the Federal Reserve and JPMorgan, which then served Bear Stearns' still warm remains to JPMorgan Chase.